Friends, thank you for being here today. What if I told you that the world's greatest investor, the man who built his fortune by buying when others panic and holding when others sell, is now doing something he has never done at this scale in his entire career? What if Warren Buffett, the Oracle of Omaha, the billionaire who preaches buying great businesses and holding forever, is now sitting on a cash pile so massive that it dwarfs the entire economic output of many countries? Have you ever stopped to wonder why, at a moment when the stock market is hitting record highs, when financial media celebrates unprecedented prosperity, and when everyone from your neighbor to your barber is talking about their investment gains, the smartest investor in history is quietly, methodically selling?
This is not about one man's portfolio decisions. This is not investment advice for the wealthy. This is a warning signal that reveals something profoundly disturbing about the true state of the market and the economy beneath the surface celebration. Warren Buffett is not guessing. He is not gambling. He is reading the same data you have access to, but he is seeing what you have been trained not to see. The numbers are staggering, the pattern is unmistakable, and the implications are terrifying. Because when the most patient, most disciplined, and most successful investor of our time is hoarding cash at levels never before seen, it means he sees something coming, something big, something that will separate those who prepared from those who believed the illusion. Financial institutions don't want you connecting these dots. Media narratives want you to keep buying, keep believing, keep participating in a market that has become completely detached from fundamental reality. But once you understand what Buffett is doing and why, you cannot unsee it. You begin to recognize not just a market correction waiting to happen, but a full system reset that will reshape wealth distribution for a generation. Let's establish the baseline facts, because the numbers here are not subtle, they are screaming. Berkshire Hathaway, Warren Buffett's investment company, is currently sitting on approximately $325 billion in cash and cash equivalents. To put that in perspective, that is more than the annual GDP of nations like Finland, Portugal, or New Zealand. It is enough money to buy every share of companies like Nike, Starbucks, or American Express entirely in cash. This is not normal for Buffett. Throughout his career, his philosophy has been clear and consistent. Cash is trash. Holding cash means missing opportunities. The whole point of investing is to put money to work in productive businesses that generate returns. Buffett famously criticized investors who sat on the sidelines during market downturns, arguing that the best time to buy is when others are fearful. Yet, here he is, in 2025, with the stock market at all-time highs, doing the exact opposite of what his public philosophy suggests. He is not buying, he is selling, aggressively. Berkshire has been a net seller of stocks for 8 consecutive quarters. He has trimmed his positions in some of his most beloved holdings, including Apple, Bank of America, and other long-term investments that he once said he would hold forever. The financial media offers comfortable explanations. They suggest Buffett is simply being cautious due to his age. They claim he is preparing for succession and wants liquidity for the next generation of Berkshire leadership. They frame this as portfolio rebalancing, a technical adjustment with no broader implications. But here is the crack in that narrative. Warren Buffett has lived through every major market cycle since the 1950s. He has seen bubbles, crashes, recoveries, and everything in between. He was buying during the 2008 financial crisis when everyone else was panicking. He deployed billions into Goldman Sachs and Bank of America when the entire financial system looked like it might collapse. That is who he is. That is his pattern. He buys fear and sells greed. So when Buffett is holding record cash during record market highs, the simplest explanation is the most obvious one. He sees the current market as overvalued, over-leveraged, and unsustainable. He is preparing for the crash that he knows, with historical certainty, must eventually come. And he is positioning himself to do what he has done after every major crash in his career: buy at a massive discount when everyone else is forced to sell. Your personal experience should validate this suspicion. If the economy is as strong as the headlines claim, why does everything feel so expensive? Why are groceries consuming a larger share of your budget? Why does housing feel increasingly unaffordable? Why are you working harder but feeling less secure? The disconnect between market celebration and lived economic reality is not an accident. It is a feature of a system that has decoupled asset prices from economic fundamentals. This brings us to the question the media will not ask, and that financial institutions do not want you to consider. If Warren Buffett, with access to every data point, every corporate insider, and every economic indicator, is preparing for a downturn, what do you think is coming? And more importantly, what are you doing to prepare? To understand why Buffett is hoarding cash, we need to look at the same metrics he uses to evaluate market conditions. And the most important metric, the one Buffett has called the single best measure of market valuation, is painting a picture that should terrify anyone paying attention. The Buffett indicator, as it has come to be known, compares the total market capitalization of all publicly traded stocks to the gross domestic product of the economy. The logic is elegantly simple. Stock prices represent the value of companies. GDP represents the total economic output. If stock prices are growing much faster than economic output, it means prices have detached from underlying value. You are paying more and more for the same amount of productivity. Historically, a ratio of 100% is considered fair value. When stocks are worth the same as annual economic output, the market is reasonably priced. During the dot-com bubble in 1999, this ratio reached 145%, and we all know what happened next. The market crashed, wiping out trillions in wealth and taking years to recover. Today, in 2025, the Buffett indicator is not at 145%. It is at 216%. Let me repeat that. The total value of the stock market is more than twice the size of the entire economy. This is not just overvalued. This is insane. This is a level of disconnection that has no historical precedent, and it is not sustainable. But the distortion goes deeper. If you zoom in from the broad market to the companies driving the gains, the numbers become even more alarming. The average price-to-earnings ratio for the top companies in the S&P 500 is currently around 66. This means investors are paying $66 for every $1 of annual earnings those companies generate. To put this in context, a normal, healthy valuation is a P/E ratio of 15 to 20. High-growth tech companies might justify a P/E of 25 or 30 if they are expected to grow earnings rapidly. But 66, that is not optimism. That is delusion. It assumes earnings will grow at rates that are mathematically implausible, that competition will never emerge, that market conditions will remain perfect indefinitely. Here is the uncomfortable truth that no one in financial media wants to say out loud. These valuations are not based on analysis. They are based on hope. Hope that the Federal Reserve will keep interest rates low. Hope that government stimulus will continue. Hope that someone else will be willing to pay even more in the future. This is not investing. This is speculation built on the greater fool theory. You are not buying because the asset is undervalued. You are buying because you believe someone else will pay more later. Warren Buffett understands this. He has seen this pattern before. In the late 1990s, during the dot-com mania, he was criticized for being too cautious, for missing out on the technology boom. People mocked him for not buying into the hype. Then the bubble burst. Trillions evaporated. And Buffett, sitting on cash, was able to buy incredible businesses at fire sale prices. In 2007, as the housing bubble reached its peak, Buffett again began pulling back. He sold positions, reduced exposure, and built up cash reserves. Once again, he was criticized. Then 2008 happened. The financial system collapsed, and Buffett deployed his cash, making some of the most profitable investments of his career by buying into companies that were fundamentally sound but temporarily distressed. The pattern is consistent. Buffett does not try to time the exact top. He does not wait for the crash to begin. He reads the valuation metrics, recognizes when prices have detached from fundamentals, and he exits. Then he waits, patiently, holding cash that earns little return in the short term, but preserves capital for the massive buying opportunity he knows will eventually arrive. Today, with $325 billion in cash, Buffett is making the same bet he has made successfully twice before in major market cycles. He is betting that current valuations are unsustainable, that a correction is inevitable, and that the patient investor with dry powder will be rewarded when panic selling creates opportunities. But there is another layer to this that goes beyond valuation metrics. It is about the structure of the market itself and how it has changed in ways that amplify both the rise and the inevitable fall. The modern stock market is no longer driven primarily by human investors making calculated decisions based on company fundamentals. It is driven by algorithms, by passive index funds, and by a handful of massive institutional players whose buying and selling create self-reinforcing momentum. When the market is rising, these algorithmic systems buy more, which pushes prices higher, which triggers more buying. This creates a feedback loop that can push valuations far beyond what traditional analysis would justify. But the same dynamic works in reverse. When selling begins, algorithms sell, which pushes prices lower, which triggers more selling. The crash, when it comes, will be faster and more violent than previous downturns, because the mechanisms that inflated the bubble will accelerate its collapse. Buffett knows this. He has studied market history. He understands that every bubble, no matter how different it appears on the surface, follows the same underlying pattern. Optimism turns to greed. Greed turns to mania. Mania turns to complacency. And complacency turns to panic. We are currently somewhere between greed and mania. The question is not if the cycle will complete. The question is when. There is also the issue of corporate debt. American corporations are sitting on record levels of debt, much of it issued during the years of near-zero interest rates. Companies borrowed not to invest in productive capacity, but to buy back their own shares, artificially inflating stock prices and enriching executives whose compensation is tied to share performance. This worked beautifully as long as interest rates stayed low and refinancing was easy. But interest rates have risen. The cost of servicing that debt has increased dramatically. And when the next downturn arrives, when revenues decline and credit markets tighten, many of these companies will face a brutal choice. Default on debt, dilute shareholders by issuing new equity, or slash costs through mass layoffs. None of these options are good for stock prices. All of them will accelerate the downturn. Buffett sees the debt, he sees the valuations, he sees the algorithmic dynamics, and he sees the same pattern that has preceded every major crash in modern history. So he is doing what the data tells him to do. He is selling into strength, converting equity positions into cash, and preparing to deploy that cash when fear creates opportunity. The financial media will not tell you this clearly because their business model depends on optimism. Brokerage firms want you buying because they earn commissions on transactions. Fund managers want you invested because they collect fees on assets under management. Financial news networks want you watching, and fear might tune you in briefly, but sustained optimism keeps you engaged daily. But Warren Buffett does not have those conflicts. His incentive is singular: maximize long-term returns for Berkshire Hathaway shareholders. And his actions, louder than any interview or annual letter, are telling you exactly what he believes is coming. There is another critical piece of this puzzle that explains both why the market has stayed elevated so long and why Buffett is nevertheless preparing for a crash. That piece is government intervention and Federal Reserve policy. And this is where the story gets particularly interesting because it reveals the fundamental fragility beneath the surface strength. Since the 2008 financial crisis, the Federal Reserve has engaged in unprecedented monetary intervention, quantitative easing, the process of creating new money digitally, and using it to buy government bonds and other assets, injected trillions of dollars into the financial system. The stated goal was to stimulate the economy, encourage lending, and support recovery. But the actual effect was to inflate asset prices. When the Fed buys bonds, it pushes bond prices up and yields down. When yields on safe assets like government bonds approach zero, investors are forced to seek returns elsewhere. They move into stocks, real estate, and other risk assets. This creates artificial demand that pushes prices higher, regardless of underlying fundamentals. This is why the market has continued rising even as valuations reached historically extreme levels. It is not that companies are performing extraordinarily well, or that economic growth is robust. It is that the Fed has made holding cash or safe assets so unrewarding that investors have no choice but to chase returns in riskier markets. Warren Buffett understands this dynamic intimately. He has even benefited from it. Berkshire's stock holdings have appreciated tremendously during this period of Fed intervention. But he also understands that this is not sustainable. Markets propped up by central bank intervention are fragile. They depend entirely on the continued willingness and ability of the Federal Reserve to keep intervening. And here is the problem. The Fed is now caught in a trap of its own making. Inflation has forced them to raise interest rates and reduce their balance sheet. But raising rates makes government debt more expensive to service, threatens corporate borrowers with higher costs, and removes the artificial support that has kept stock prices elevated. If the Fed continues to tighten, they risk triggering the very crash they spent years trying to prevent. But if they reverse course and start cutting rates or resuming quantitative easing, they risk losing credibility and allowing inflation to spiral out of control. They are trapped between two bad options, and neither one prevents the eventual reckoning that Buffett is preparing for. There is also the fiscal side of the equation. The U.S. government is running massive deficits, borrowing trillions of dollars annually to fund spending that exceeds tax revenues. This deficit spending has propped up consumption and prevented the economy from contracting as much as it otherwise would have. But this too is unsustainable. At some point, bond markets will demand higher yields to compensate for the risk of lending to a government with exploding debt levels. When that happens, interest costs will consume an ever larger share of the federal budget, crowding out other spending and forcing difficult choices. The fiscal support that has kept the economy afloat will evaporate, and the downturn will accelerate. Buffett is not betting against the Fed's ability to intervene. He is betting that the interventions have created distortions that cannot be maintained indefinitely. He is betting that the longer the bubble inflates, the more severe the eventual correction will be. And he is positioning himself to profit from that correction by holding cash that will allow him to buy assets at distressed prices. This is not pessimism. This is pattern recognition. Every interventionist cycle in history has ended the same way. The distortions become too large, the imbalance is too severe, and the system resets violently. The only question is timing, and Buffett, with his record cash pile, is signaling that he believes the timing is closer than most people think. Now let's bring this down from the abstract world of market indicators and Fed policy to the concrete reality of how this affects ordinary people. Because the disconnect between what Buffett is doing and what most Americans are experiencing reveals something deeply troubling about the structure of our economy. If you are a typical American worker, you are probably not feeling the benefits of record stock market highs. You do not own significant equity positions. Your retirement account, if you have one, might have some exposure through a 401k, but the real wealth is concentrated at the top. The wealthiest 10% of Americans own approximately 89% of all stocks. The bottom 50% own essentially nothing. This means that when the market rises, the benefits flow overwhelmingly to people who are already wealthy. And when the market crashes, as Buffett is preparing for, the losses will also be concentrated among the wealthy. Except that is not quite true, because the wealthy have the resources to weather crashes. They have diversified portfolios, access to sophisticated financial advice, and most importantly, they do not need to sell at the bottom. But ordinary workers do get hurt. When the market crashes, companies respond by cutting costs. That means layoffs, hiring freezes, and reduced wages. The stock market might be an abstraction to most people, but the employment consequences of a crash are brutally real. You lose your job not because you own stocks that declined, but because the company you work for is trying to protect its stock price by cutting labor costs. There is also the retirement dimension. Millions of Americans have their retirement savings tied up in 401k plans invested in stock index funds. They have been told for decades that this is the safe, smart way to save for retirement. Buy and hold, diversify, stay invested through market cycles. And for many years, this advice worked reasonably well. But what happens when someone is approaching retirement or already retired, drawing down their savings, and the market crashes by 40% or 50%? Suddenly, their retirement nest egg has been cut in half. They cannot wait for the recovery because they need the money now to pay for living expenses. So they are forced to sell at the bottom, locking in losses and permanently reducing their financial security. Warren Buffett does not face this problem. He can hold cash indefinitely. He does not need to draw down his portfolio to pay for groceries or health care. He can wait years for the perfect buying opportunity. But the average American worker approaching retirement cannot. They are trapped in a system that exposes them to catastrophic downside risk while concentrating the upside gains among the already wealthy. Consider the emotional and psychological toll as well. For years, you have been told that if you work hard, save diligently, and invest in the market, you will be rewarded with a secure retirement. You followed the rules, you did everything right, and then, through no fault of your own, a market crash that you did not see coming and could not have prevented wipes out decades of savings. The frustration, the anger, the sense of betrayal, these are not just individual tragedies. They are the raw materials of social and political instability. When millions of people simultaneously realize that the system is rigged, that the game is designed for them to lose, the consequences extend far beyond finance. And here is what makes Buffett's actions so revealing. He is not just protecting his own wealth. He is recognizing that the system has become so distorted, so disconnected from reality, that collapse is inevitable. He is not causing the crash. He is reading the same signals that anyone can see if they look honestly at the data. But unlike most people, he has the resources to position himself advantageously. This is not a criticism of Buffett personally. He is playing the game according to its rules and doing so more successfully than anyone else in history. But his success throws into sharp relief just how unequal the game has become. The wealthy can see the crash coming and prepare. The poor and middle class are told to stay invested, to keep believing, to trust that everything will work out. And when the crash happens, they pay the price while the wealthy swoop in to buy assets at bargain prices. To fully understand what Buffett is doing and why it matters, we need to place this moment in historical context. Because while the specific mechanisms and technologies may differ, the underlying pattern of boom, bubble, and bust has repeated throughout financial history with remarkable consistency. In the 1920s, the stock market soared to unprecedented heights. Ordinary people, convinced that a new era of permanent prosperity had arrived, borrowed money to buy stocks. Margin lending allowed investors to control large positions with small amounts of their own capital. When everyone is buying and prices are rising, this leverage magnifies gains. But when sentiment shifts and prices fall, the same leverage magnifies losses and enforces catastrophic selling. The crash of 1929 was not caused by a single event. It was caused by the accumulation of unsustainable imbalances. Stocks were overvalued, debt was excessive, and the belief that prices could only go up had become so widespread that no one was prepared for the reversal. When it came fast. Fortunes evaporated, banks failed, and the economy entered a depression that lasted a decade. The parallel to today is striking. We have record valuations. We have record debt, both corporate and government. And we have a widespread belief, particularly among younger investors who have never experienced a true bear market, that crashes are a thing of the past, that central banks will always intervene, that buying the dip always works. Warren Buffett lived through the aftermath of the Great Depression. He studied it extensively. He understands that the pattern is not an anomaly, but a feature of human psychology interacting with financial markets. Greed and fear are constants. The mechanisms change, but the cycle remains. In the late 1990s, the dot-com bubble presented the same pattern with different details. The internet was revolutionary, and optimism about its potential was justified. But that did not mean any price was justified for any company with a website. Valuations reached absurd levels. Companies with no revenues, let alone profits, were worth billions. And once again, the smart money, including Buffett, recognized the mania and stepped aside. When the bubble burst in 2000, trillions in market value disappeared. The Nasdaq, heavily weighted toward technology stocks, fell nearly 80% from its peak. Retirement accounts were devastated. Companies went bankrupt. And once again, those with cash were able to buy great businesses at reasonable prices. The 2008 financial crisis followed a similar script. This time, the bubble was in housing. Easy credit, loose lending standards, and the widespread belief that home prices could never fall created a mania. When prices finally did fall, the entire financial system, which had become deeply interconnected through complex derivatives, nearly collapsed. Buffett, once again, had been cautious in the years leading up to 2008. He had raised cash. And when the crisis hit, he deployed billions into companies like Goldman Sachs and General Electric, securing preferential terms that generated enormous returns once the recovery began.
Now, in 2025, we are in the longest bull market in history. It has been propped up by unprecedented monetary and fiscal intervention. Valuations have reached levels that exceed previous bubbles. And the belief that this time is different, that modern central banks have figured out how to prevent crashes, has become almost universal. But history teaches a clear lesson. This time is never different. The details change. The cast of characters changes. The technologies and financial instruments change. But the underlying psychology, the boom-bust cycle, remains constant. Warren Buffett, student of history and master of pattern recognition, is reading the same signals that preceded 1929, 2000, and 2008. He is not predicting the exact timing. No one can. But he is certain enough about the direction that he is willing to hold $325 billion in cash, earning minimal returns in order to be ready when the opportunity arrives. For ordinary investors, the lesson should be clear. If the greatest investor in history, with access to information and resources beyond what any individual can access, is preparing for a crash, perhaps it is worth considering what that means for your own financial position. This is not about panic. It is not about selling everything and hiding under a mattress. But it is about honest risk assessment. It is about recognizing that markets do not go up forever, that valuations matter, and that the longer a bubble inflates, the more painful the eventual correction. So where does this leave us? Warren Buffett is hoarding $325 billion in cash while the market hits record highs. This is not a random decision. It is not age-related caution. It is not poor timing. It is a calculated position based on decades of experience and a clear-eyed assessment of current market conditions. Buffett is telling you through his actions that current valuations are unsustainable, that the market has become detached from fundamental economic reality, that the interventions by the Federal Reserve and government spending have created artificial support that cannot last indefinitely, and that when the correction comes, it will create the buying opportunity of a generation for those who are prepared. The uncomfortable truth is that most people are not prepared. They are fully invested, believing the narrative that markets always recover, that buying and holding always works, that this time is different. They have been conditioned to ignore warning signs and to dismiss caution as pessimism. But Buffett is not a pessimist. He is an optimist about the long-term prospects of American business. That is why he wants to own great companies. But he is also a realist about valuations. And when prices are too high, the intelligent investor steps aside and waits. For you, the individual trying to navigate this environment, the lesson is not to copy Buffett's exact strategy. You are not managing hundreds of billions of dollars. Your situation, your timeline, and your needs are different. But you can learn from his approach. You can look honestly at valuations and recognize when prices have disconnected from fundamentals. You can maintain some liquidity rather than being fully invested at market peaks. You can resist the pressure to chase returns when everyone else is buying. And you can prepare mentally and financially for the reality that markets move in cycles, and the current cycle will eventually end, as all cycles do. The market is not going to crash because Warren Buffett is holding cash. The market is going to crash because valuations are extreme, debt is excessive, and the imbalances that have built up over years of intervention cannot be sustained indefinitely. Buffett's cash position is not causing the problem. It is responding to it. When the crash comes, and history suggests it will, there will be two types of people. Those who are forced to sell at the bottom because they are over-leveraged, overexposed, and unprepared, and those who have preserved capital and are ready to buy quality assets at fire sale prices. Warren Buffett has positioned himself to be in the second category. The question you need to ask yourself is which category you are in. And if the answer makes you uncomfortable, perhaps it is time to think differently about risk, about valuation, and about what it means to be truly prepared for what comes next. The greatest investor in history is sending a signal. The question is whether you are paying attention. If this analysis has changed how you see the current market environment, share it. Because the mainstream narrative wants you to keep buying, keep believing, and keep ignoring the warning signs. But the data, the history, and Warren Buffett's actions tell a different story. And that story, uncomfortable as it may be, is the one you need to hear. This is not about fear. This is about preparation. This is not about pessimism. This is about realism. And this is not about missing out. This is about being ready when the opportunity of a generation arrives. Welcome to the reality that Warren Buffett sees. The question is what you are going to do about it.